You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
Hello, thank you for joining Minds of Commercial Real Estate. Today we have John Wittenberg from LXK Group. John, thank you for coming on the podcast.
Absolutely. Thanks for having me.
Well, let's go in and start and give us a little bit of background about yourself.
Sure. So I got into the real estate business back in the great financial crisis. I was an economist at Fannie Mae. We built the models that became the decision engine for a lot of the home modifications that happened at that time. But I wanted to get into commercial real estate. And so when I moved back to Florida, I interviewed and talked to as many people as I could. And eventually they just said, nothing doing right now. Why don't you become a broker? And so did that for a little bit, learned the ropes, and then became an acquisitions guy for a local developer here. And that brought me into the hotel world. And so ran around bird dogging deals across top markets in the US, got into asset management, acquisitions, capital markets, and business strategy. And eventually when everything collapsed in 2020, I left and joined up with a buddy to build a portfolio of extended stay economy scale hotels. So we built that to 8 properties. And then last year, at the beginning of 2024, I left there and moved back into institutional grade asset management for hotels, mostly in the high-end luxury and upper upscale segments.
So tell us a little bit about during your tenure at the extended stays. How was it during COVID? When did it start performing? What was your experience there?
Sure, yeah. So it was really interesting because while everything else was suffering in the hospitality world, extended stay was doing very well. A lot of our guests were primarily transitional housing and fixed income. And then we had some traveling trades, but I mean, it was essentially like a furnished apartment for many people. That was performing very well through COVID. And then in 2023, things really started to shift once inflation took hold and groceries, gas, et cetera, were taking up a bigger share of our guests' wallets. We started to see occupancy decline a little bit. And we saw this across the entire industry. And then in 2024, it really picked up. And so it's been kind of a challenging go recently. And now with tariffs and all these things, the whole industry, the travel industry is kind of, waiting to see where everything pans out from here.
In the extended stays, what was the ADR, would you say, per hotel, and then the average of all the 8 hotels, ADR being the average daily rate for the consumers?
Yeah, so we were actually pricing more on a weekly rate. And so our weekly rate was $400 to $425, $450 per week. And that comes out to somewhere around $40 per night. We also look at RevPAR across the entire asset. So that's revenue per available room. And so the RevPAR was about $40 to $42 per night. And so when we could get to that number, then we can support a pretty robust ecosystem of guests, as well as some traveling trades and some of these other folks.
What was the vacancy during COVID and after COVID, would you say?
During COVID, we were at about 10%. After COVID, it was more in the 20%-ish range. And you have to think about the alternatives that a lot of our guests were having at that time is they could move into as employment picked up and other options became available, they started moving out. We also saw a lot of contraction where people were staying within the environment and kind of shacking up with multiple families in the room. So whereas we had occupancy in the 2 to 3 people per room during COVID, we started to see 4, 5, 6 people per room, which was very different and puts a different stress on the asset.
Well, John, so let's go back and go to your Fannie Mae days. Tell me about your experience then.
Yeah, so I was at Fannie Mae in 2009 and 10, which was kind of a really exciting time to be there because we were working for the Treasury Department on their TARP program called Making Home Affordable. Basically, using all our credit information, $1 trillion book of business, And we were doing big data before big data was big data, right? We had, there were no open source tools really to use yet. We were using very expensive software to model out default rates and credit risk and all of those things. And so having that much data and being able to use that kind of on a whim and tease out insights is super exciting. But it wasn't really something I wanted to build my career on. I really wanted to get into the deal space, and I wanted to get into commercial. And at the time, Fannie Mae had a very small commercial real estate or multifamily business. Freddie Mac actually had a bigger multifamily business at the time. You know, as I was looking at it and talking to folks in the credit risk department there, it was just very difficult for them to build a uniform model the way that we had for single family. Because single family kind of follows very similar patterns. You can judge a lot based on credit reports, credit history, based on the location and the asset type. And so multifamily is quite a bit different because you have deferred maintenance and you have local comps and all these things that don't mirror the simple kind of price per pound pricing that you can get on a single family evaluation.
So do you just work for the company, or do you also consult for other hotel owners?
I do consult for other hotel owners. So I do third-party asset management, and then I also do management consulting to help kind of improve operations.
Going to what your niche is now, you are focusing on the hotel industry, but on the higher end.
Right. Yeah. So from 2012 through 2020, that's where I spent a lot of my time, was on the higher end. And so we were doing lifestyle hotels, full service hotels and resorts. And these are properties that are 200, 300, 400 rooms, 10 to 30,000 square feet of event space, multiple food and beverage outlets. And it was at a time we were investing in lifestyle at a time when lifestyle was just kind of a newer thing. Before that, you had a lot of the traditional brands like the full service Marriott's, Westin, that kind of thing. And there was an emergence that the only lifestyle brands that you had were, Kimpton, Joie de Vie, Thompson. And now you start to see more lifestyle being injected into the major brands. And so you have Graduate Hotels, which was recently acquired by Hilton. You have the Canopy or Curio brands, all of these different Autograph Collection, all these different collections and things like that enable hoteliers to access that kind of guest, but also plug into a big distribution system through the big brands. So it's a really great time to be investing in that kind of property right now.
And on these lifestyle hotels, do they have typically one location, multiple locations? Were they expanding?
Yeah, so the ones that I was working on, we had multiple locations. We had 4 properties of the brand that I was working on. We were looking to expand, but it's really challenging in the hotel market to build an independent brand or build any new brand, because there's only so much that's built already, right? And in order to convert to a different brand, you have to pay liquidated damages, which is basically a fee of usually the prior 2 to 3 years of franchise fees to back out of the franchise agreement. And so that can add significant cost to the renovation and the project. A lot of the deals didn't really pencil unless we got really creative on value engineering and finding and unlocking value where other people just don't see it.
Typically, how long are those franchise agreements for the major brands?
So it depends. A lot of the franchise agreements are about 15 years. When you get into the luxury space, usually those brands come with management. So the brand will also be the manager, whereas with traditional franchisees, you can operate as a third party and just take the brand. So in the luxury space, you're looking more at 30-year agreements where you have the management and the branding all combined.
Got it. So when you compare that to when you went to this extended stay for about 4 years, and now you're back into the lifestyle, hotel industry, what is your recommendations?
So, it's really interesting because both of them are really hot right now. So if you look at the hotel landscape, over the 90s and early 2000s, select service was really hot. So you're thinking about your courtyards, your Holiday Inn Express, the Homewood Suites, those type of properties started to pick up. And then in the 2000 teens and into now, that's where lifestyle and extended stay really started to grow. And so today you see a lot of new extended stay brands coming out, and they're moving down the service scale. Hilton, for example, introduced an economy scale conversion brand recently, which a few years ago would have been unheard of, but they see the opportunity in that space. So I think the extended stay world will continue to develop because it offers a lodging alternative that many people are seeking. And you see this in vacation rentals and STRs and that sort of thing. But then also on the other end of that is this expansion of lifestyle. I think the acquisition of Graduate Hotels by Hilton, and then the recent Hyatt acquisition as well, made it very clear that this is a concept worth pursuing. And so people want experiential travel. They want to feel and touch the environment that they're visiting. And so that's where lifestyle really fits in. You can get married or have a bar mitzvah anywhere. Would you rather do it at somewhere that feels like the location where you are, or just you could be in any Marriott or any Westin or any DoubleTree in the world?
During, and after COVID, financing, I think we saw a lot of new hotels on the lifestyle brand, and any major hotels were, expanding a lot. Financing was available. But when we look back in the last 2 years, when the financing rates have gone up, costs have gone up, what are you seeing in terms of that?
Yeah, it's a tough time because from 2020 until 2023, 24, a lot of the big hotels just weren't able to reinvest in their businesses because they just didn't have much business to support it, right? So you had these big event spaces that would go unrenovated, and many, going into COVID, didn't do the renovation that they needed. And so when business travel and group travel came back in 2024, they came back to tired boxes, right? Tired hotels, tired experiences. And at the same time, the market for financing these renovations kind of sank. So there's still a challenge for financing these properties. We in 2023 had to refinance a deal, and in the economy scale space, most of those things were being financed by community banks. And at the time, this was right after First Republic had failed, and all the community banks had basically said, "Hey, we're risk off. We don't really want to deal with the risk of a hotel." And so we had to go to the private markets and actually syndicated debt for the deal so that we could do the expansion or do the refinance and invest in the asset without having to go to a community bank. And so we're seeing the same thing now, but more at a project level. So if you have good in-place debt, then you can go raise, a mezzanine piece or preferred equity to do the renovation that's needed in order to satisfy the guests' demands.
Some of the loans that are in the first position, like the CMBS or some other ones, don't allow a mezzanine financing. What would you do in those circumstances?
So in those cases, it's really about raising some white knight capital often, so you go out and get some equity, put them in a preferred position, or, you can always go back to the lender. I always recommend going to the lender and having an open conversation about this. They're more forgiving than most people want to believe. And if you start that conversation early, you're more likely to get a favorable outcome than if you come to the last minute and request something that is just kind of a solution that they're drowning in with other requests from other borrowers.
John, do you mainly focus in the US or worldwide?
Yeah, most of my business is in the US, but I would classify it more as North America and the Caribbean. So we have an asset in Toronto, and then a few that we're reviewing in major islands in the Caribbean.
With the group that you're currently in, are you guys in expansion mode? Are you in the remodeling? What phase would you say you're in?
Absolutely. So we see the tremendous opportunity now with distress that's coming to the travel industry to make some great generational bets. A lot of owners have put off renovations, they've put off capitalization, they've been funding losses for a few years. And so in a way, the piper's coming time for being paid. And so I think there will be some capitulation in the market. I don't think it's all going to be distressed deals, but there's going to be some folks who say, look, it's not for us anymore. And so we're ready to sell. And in those cases, it's best to be in a position to catch the opportunity and really capitalize on where the strategic investments are in the asset, whether that's a renovation, repositioning the operations, or even repositioning the hotel entirely.
For commercial real estate investors out there that have a big portfolio in hotels or are starting to get into hotels or have a minor percentage in hotels, what recommendations would you have for them?
Every situation is different. The one thing that I love about investing in hotels is that there are multiple levers for pulling to get and generate additional value. I would be focusing very intensely on asset management right now and leaning out the operation. One thing that I would be very careful of is cutting too deeply in sales and marketing. One thing we saw in 2020 is that the first thing to go was your sales team and your digital marketing spend. When the market came back, it was also the last thing to come back online. And I think now there's this tremendous opportunity in many markets that the primary hoteliers have not reinvested back into their sales teams. And so by over-indexing on digital marketing, you're leaving a lot on the table for somebody who's out there just knocking on doors. And so if you can go out and hire someone either overseas or someone locally to go knock on those doors, you're likely to get more business that way than pouring more money into digital marketing.
Well, thank you, John. Thank you for insights into the hotel industry, and look forward to having you on a further podcast again.
Looking forward to it. Thanks so much for having me.
Thank you. Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. Let's get together. Let's get together.